Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome, Professor. Today is January 29th, 2025. You predicted it. The Fed today took a pause. They announced this afternoon. You were exactly spot on. Professor, how did the Fed decide to pause their target Fed funds rate today? And if they decided to lower rates, how would you and Wall Street take advantage of a lower Fed funds rate?
Well, the current target for federal funds is 4.25 to 4.5. And what that means is if you invest money at 4.25 in the repo market, that's what you can make. And if they lower it to 4 to 4.25, that's what you'll make, 4 to 4.25. And they didn't do that, so they left it at 4.25 to 1/2. But let's suppose for a moment they did it. Suppose they lowered it to the 4 to 4.25 range, and let's, to pick a number, say that settled at 4.20. It'll settle somewhere in that range. The T-bills all yield about 4.30. So I'd buy the 1-month Treasury bill at 4.30 and finance it at 4.20 and make the difference, 10 basis points, with no risk. The only thing that can upset that is if the Federal Reserve decides next week to change its mind and raise it back up. They'd have to do that without a meeting. They've never done that a week after going one direction or even a month after going one direction. And they wouldn't do that in this case either. So what that means is they're not going to do it at all because they're not going to want people like me or Wall Street firms buying Treasury bills at 4.30 and financing them at 4.20 for a pure arbitrage profit. I can't do much of that, but Morgan Stanley could do, 50 billion, just like that, in a heartbeat. So unless you want Wall Street to arbitrage the heck out of the Treasury bill market, you will wait till the Treasury bills have settled below 4.25 before you move the borrowing range down to 4 to 1/4.
The J.P. Morgans of the world, the Goldmans of the world, if you did that arbitrage $100 billion at 10 basis points, that's $100 million. Do they have to provide collateral? And specifically, mechanically, how do they do that? Do they go out and buy the 1-month Treasury, which is today 4.33, and sell into the Fed funds market?
No, it takes no money to do that trade. What you do is you commit to buy at 4.30. Let's say you're going to settle tomorrow. Okay, so tomorrow comes, you have to put up the money. You go into the repo market and repo that Treasury out at 4.20, let's say. So you owe 4.20 in cash payments, then you're going to collect 4.30. So it's a clean arbitrage.
So they make 10 basis points on, say, $100 billion. That's $100 million a year for virtually a risk-free trade without any collateral.
That's correct.
Pretty good business.
But the Fed never does that. Having said that, the Fed has no record of moving the repo market outside of where the current T-bills are. So if you know the current T-bill yields, which are 4.30, then you know what the funds rate target's going to be. It's going to be something that captures that 4.30, and it does. 4.25 to 4.5 has 4.30 sitting right inside of it.
And so you knew the Fed was not going to change target rate today because the 1 month is roughly 4.33, and the Fed funds target rate is 4.25 to 4.5. So
that's right. Now, suppose there had been a big rally in the Treasury bill market, and they had taken all those rates down to 4.20. Then you could easily predict they were going to bring the funds target rate down to 4 to 1/4. And all this other discussion about what's inflation doing, that's frankly completely irrelevant unless it affects the T-bill yields. So all you have to do if you want to know which way the fund's going to move, just watch the Treasury bill yields. If Treasury bill yields had gone up to 4.60, then they'd be raising the target range. It's very easy to predict, and obvious. What's happening here is similar securities should earn a similar yield. There's no getting around that fundamental principle of economics.
If not, the big firms will arbitrage and make a significant profit.
Big firms, little firms, everybody. Now, that could pull the T-bill yields down. There's no question if that took place, but it would be a major embarrassment to the Fed.
Professor, this week DeepSeek came out. 3 Chinese individuals designed the new AI, rocked the markets. Good for the world? What's going on? What effect on the economy does that have?
Well, broadly speaking, it's very good for the world. Because what it does, it has an impact that is in some ways kind of like the impact of the Internet. Internet had the virtue of lowering communication costs. You're too young, Hunter, to remember what it used to cost to call London from the U.S. back in the day. But it was expensive. $10 a minute was not out of the question. Today, you make that call, it costs you essentially nothing at the margin. Communication costs zero. You can communicate with anybody in the world just by sending emails around and all that. This has the same significance of cost reduction. What's been happening, and last week was interesting, the U.S. was celebrating its leadership in AI, artificial intelligence, and President Trump announced a $500 billion investment led by the Saudis and others. And that was to proclaim that the U.S. was the leader in AI. But the interesting thing about AI is it's unbelievably expensive. And, of course, you have to use NVIDIA's chips, which is why NVIDIA is now, or was until Monday came along, the most expensive stock in the world, either that or Apple. They were both above $3 trillion in market capitalization. And they were the 2 largest companies in the world, and NVIDIA came out of nowhere. They were worth just a couple $100 billion just a few years back. So AI looked like everything, and it has been driving the stock market. All the artificial intelligence stocks have been going straight up. And yet the costs are enormous. Everybody that was looking to get into it, Meta and Microsoft and so forth, were talking about spending $50 billion, $100 billion. Well, these guys came up with a product, and we, of course, don't know all the details we'd like to know. But according to them, it cost $5.6 million. Now, let me give you an analogy. Suppose you wanted to know how Florida was going to vote in the next election, and you set up a polling company. And to really get a fix on it, you said you had to poll 1 million Floridian voters. And that was going to cost a lot of money to do 1 million Floridian voters. So you did that, and you spent, let's say, $20 million setting it all up and getting your sample together and polling all these people. And it was pretty accurate. But you spent $20 million. Now suppose somebody comes along, and instead of spending $20 million, they're going to spend $250,000. But they're only going to poll 1,000 people. Now, their poll is probably not likely to be as accurate as your poll, but the costs are very different. They're spending $200,000, not $20 million to poll, and their accuracy is probably almost as good as yours. We know from statistical theory that that's probably true. Statistical theory, that's why they only poll 1,000. People wonder sometimes why they poll so few. And the reason is not that you can't get more accurate. It's just costs like heck to get more accurate. So, sure, if you polled everybody in the state, you'd be 100% right on. You'd have trouble missing if you polled everybody, but imagine what that would cost. So that's what happened here. OpenAI said it took billions of dollars to develop ChatGPT. And in the early tests, ChatGPT doesn't perform any better than this new DeepSeek. Now, in some things it's a little better, some things it's a little worse. And a number of people have looked at it. Now, let me just cite one famous tech guy, Andreessen. Mark Andreessen, who's quite famous in the tech world. He's the one that designed the Netscape, which was the first web browser. And he's made a huge amount of money in the tech sector investing in companies. And he says this thing works. This DeepSeek is marvelous. Well, look at the costs. $5.6 million against $50 billion. That's quite a difference. Then if you use some other estimates that I've heard, it costs 65 times as much to develop GPT applications as it would using DeepSeek. 65 times as much. Now, today, I don't know if it's gotten around, but there was another announcement from another Chinese group, I don't know if you saw that, saying that they have a product even better than DeepSeek, and it didn't cost any more than DeepSeek. And I told my class this morning, or yesterday morning when I was discussing this in class, I said over the next 6 months, you're probably going to have as many as 50 announcements from all over the world. They'll come from India and Vietnam and China and all over the place, where 2 or 3 folks in their basement who happen to have chips that aren't necessarily as good as NVIDIA, but they're not bad chips. And they're able to do a lot of this, too, through software. And that's what happened. The Chinese kids that put this together did it through software. So the broad impact is, one, it looks like the U.S. perhaps wasted a lot of money, which if you read some of the statements made by some of the folks in this, Sam Altman and others, you really kind of wonder, because the statements are pretty outlandish. I read a recent interview by Sam Altman in Financial Times, and he's talking like we can put this thing on the moon next week or Mars or something. There's a lot of strong statements about where this is all going, but so far it's not much beyond what we already know, ChatGPT, and many people who've used it for applications are not real happy about how the applications worked. I, for one, for example, have used Copilot, and that Microsoft has as its AI agent, and I've had to turn it off because it interferes with my ability to use Microsoft Word and PowerPoint and other things that I use regularly. Now, one could argue that I'm just a dinosaur, and maybe if I took the time to learn how to use it, it might be very beneficial. But so far, the initial stages of AI and its promise, it's still just promise. We haven't seen the cost reduction in industries. We're not sure how people can monetize it to increase their profits. That's not to say they won't be able to, but we're not there yet. And yet, all of a sudden, here comes some folks that say, this can be done a lot cheaper than you guys are doing it. So that's good news for the world, because now we're going to have a very efficient way of attacking large data sources, perhaps in a cheaper way. But it's not very good for the tech giants who've been proclaiming AI as the wave of the future, but so far haven't proven it, and have spent an enormous amount of money and made an enormous amount of promises that so far haven't delivered, and the stock market's sitting at an all-time high with valuations that are pretty crazy. So the first victim of all this was NVIDIA itself. They make the hardware that drives artificial intelligence. And they lost $600 billion in market cap on Monday. Now, they got some of that back, maybe about a third of that back on Tuesday, but a total of $1 trillion evaporated from the stock market on Monday from the tech sector. And a lot of stocks were up on Monday, but those stocks got hit hard. So the promise of AI is still a promise. It's not a reality at all. I'm not familiar with anyone who proclaims that they've saved an enormous amount of money doing this. Now, the interesting thing about this that wasn't emphasized too much is it's open source, like AI. In other words, if you're a developer, they've provided the source. So you can take what they've done and write your own version and put it in your own application. Now, that's a huge plus. And I think you're seeing that as a trend in all of the AI world. So if you look fast forward to 5 years out, it'll be cheap, available, and to the extent it has uses, it'll be used.
Professor, you're the best of the best. Next week, we'll have a new podcast. We're all watching the yield on the 1 and 3 months U.S. Treasury. Thank you, Professor.
Thank you, Hunter.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.